companies had failed. This crisis cost taxpayers $124 billion and cost many people their life savings.
It may be the biggest bank heist in our history.
Thousands of savings and loan executives went to jail for looting their companies. One of the most extreme cases was Charles Keating.
Mr. Keating, you got a word?
In 1985, when federal regulators began investigating him, Keating hired an economist named Alan Greenspan. In this letter to regulators, Greenspan praised Keating's sound business plans and expertise and said he saw no risk in allowing Keating to invest his customers' money. Keating reportedly paid Greenspan $40,000. Charles Keating went to prison shortly afterwards. As for Alan Greenspan, President Reagan appointed him chairman of America's central bank, the Federal Reserve. Greenspan was reappointed by Presidents Clinton and George W. Bush. During the Clinton administration, deregulation continued under Greenspan, and Treasury Secretaries Robert Rubin, the former CEO of the investment bank Goldman Sachs, and Larry Summers, a Harvard economics professor.
The financial sector, Wall Street, being powerful, having lobbies, having lots of money, step by step captured the political system, both on the Democratic and the Republican side.
By the late 1990s, the financial sector had consolidated into a few gigantic firms, each of them so large that their failure could threaten the whole system. And the Clinton administration helped them grow even larger. In 1998, Citicorp and Travelers merged to form Citigroup, the largest financial services company in the world. The merger violated the Glass-Steagall Act, a law passed after the Great Depression, which prevented banks with consumer deposits from engaging in risky investment banking activities.
It was illegal to acquire Travelers. Greenspan said nothing. The Federal Reserve gave him an exemption for a year, and then they got the law passed.
In 1999, at the urging of Summers and Rubin, Congress passed the Graham-Leach-Bliley Act, known to some as the Citigroup Relief Act. It overturned Glass-Steagall and cleared the way for future mergers.
Why do you have big banks? Well, because banks like monopoly power, because banks like lobbying power, because banks know that when they're too big, they will be bailed.
Markets are inherently unstable, or at least potentially unstable. And appropriate metaphor is the oil tankers. They're very big, and therefore you have to put in compartments to prevent the sloshing around of oil from capsizing the boat. The design of the boat has to take that into account. And after the Depression, the regulations actually introduced these very watertight compartments. And deregulation has led to the end of compartmentalization.
The next crisis came at the end of the 90s. The investment banks fueled a massive bubble in internet stocks, which was followed by a crash in 2001 that caused $5 trillion in investment losses. The Securities and Exchange Commission, the federal agency which had been created during the Depression to regulate investment banking, had done nothing.
In the absence of meaningful federal action, and there has been none, and given the clear failure of self-regulation, it has become necessary for others to step in and adopt the protections needed.
Eliot Spitzer's investigation revealed that the investment banks had promoted internet companies they knew would fail. Stock analysts were being paid based on how much business they brought in, and what they said publicly was quite different from what they said privately.
Infospace, given the highest possible rating, dismissed by an analyst as a piece of junk. Excite, also highly rated, called such a piece of crap.
The defense that was proffered by many of the investment banks was not, you're wrong. It was, everybody's doing it and everybody knows it's going on, and therefore nobody should rely on these analysts anyway.
In December 2002, 10 investment banks settled the case for a total of $1.4 billion and promised to change their ways. Scott Talbot is the chief lobbyist for the Financial Services Roundtable, one of the most powerful groups in Washington, which represents nearly all of the world's largest financial companies.
Are you comfortable with the fact that several of your member companies have engaged in large-scale criminal activity?
You'll have to be specific.
Okay.
First of all, criminal activity shouldn't be accepted, period.
Since deregulation began, the world's biggest financial firms have been caught laundering money, defrauding customers, and cooking their books again and again and again. Credit Suisse helped funnel money for Iran's nuclear program and for the Aerospace Industries Organization of Iran, which builds ballistic missiles.
Any information that would identify it as Iranian would be removed.
The bank was fined $536 million. Citibank helped funnel $100 million of drug money out of Mexico.
Did you comment that she should, quote, lose any documents connected with the account?
I said that in a kidding manner. It was at the early stages of this. I did not mean it seriously.
Between 1998 and 2003, Fannie Mae overstated its earnings by more than $10 billion.
These accounting standards are highly complex and require determinations over which experts often disagree.
CEO Franklin Raines, who used to be President Clinton's budget director, received over $52 million in bonuses. When UBS was caught helping wealthy Americans evade taxes, they refused to cooperate with the U.S. government.
Would you be willing to supply the names?
If there's a treaty framework...
No treaty framework. You've agreed you participated in a fraud.
But while the companies face unprecedented fines, the investment firms do not have to admit any wrongdoing.
When you're this large and you're dealing with this many products and this many customers, mistakes happen.
The financial services industry seems to have a level of criminality that is, somewhat distinctive. When was the last time that Cisco or Intel or Google or Apple or IBM,
I totally agree with you about high-tech versus financial services, but high-tech...
So how come?
High-tech is a fundamentally creative business where the value generation and the income derives from actually creating something new and different.
Beginning in the 1990s, deregulation and advances in technology led to an explosion of complex financial products called derivatives. Economists and bankers claimed they made markets safer, but instead, they made them unstable.
Since the end of the Cold War, a lot of former physicists, mathematicians decided to apply their skills not on, Cold War technology, but on financial markets. And together with investment bankers and hedge funds.
Creating different weapons.
Absolutely. As Warren Buffett said, weapons of mass destruction.
Regulators, politicians, and business people did not take seriously the threat of financial innovation on the stability of the financial system.
Using derivatives, bankers could gamble on virtually anything. They could bet on the rise or fall of oil prices, the bankruptcy of a company, even the weather. By the late 1990s, derivatives were a $50 trillion unregulated market. In 1998, someone tried to regulate them. Brooksley Born graduated first in her class at Stanford Law School and was the first woman to edit a major law review. After running the derivatives practice at Arnold & Porter, Born was appointed by President Clinton to chair the Commodity Futures Trading Commission, which oversaw the derivatives market.
Brooksley Born asked me if I would come work with her. We decided that this was a serious, potentially destabilizing market.
In May of 1998, the CFTC issued a proposal to regulate derivatives. Clinton's Treasury Department had an immediate response.
I happened to go into Brooksley's office, and she was just putting down the receiver on her telephone, and the blood had drained from her face. And she looked at me and said, "That was Larry Summers. He had 13 bankers in his office. He conveyed it in a very bullying fashion, sort of directing her to stop.
The banks were now heavily reliant for earnings on these types of activities. And that led to a titanic battle to prevent this set of instruments from being regulated.
Shortly after the phone call from Summers, Greenspan, Rubin, and SEC Chairman Arthur Levitt issued a joint statement condemning Bourne and recommending legislation to keep derivatives unregulated.
Regulation of derivatives transactions that are privately negotiated by professionals is unnecessary.
She was overruled, unfortunately, first by the Clinton administration and then by the Congress. In 2000, Senator Phil Gramm took a major role in getting a bill passed that pretty much exempted derivatives from regulation.
They are unifying markets, they're reducing regulatory burden. I believe that we need to do it.
It is our very great hope that it will be possible to move this year on legislation that in a suitable way goes to create legal certainty for OTC derivatives.
I wish to associate myself with all of the remarks of Secretary Summers.
In December of 2000, Congress passed the Commodity Futures Modernization Act. Written with the help of financial industry lobbyists, it banned the regulation of derivatives.
Once that was done, it was off to the races. And the use of derivatives and financial innovation exploded dramatically after 2000.
So help me God. So help me God.
By the time George W. Bush took office in 2001, the U.S. financial sector was vastly more profitable, concentrated, and powerful than ever before. Dominating this industry were 5 investment banks, 2 financial conglomerates, 3 securities insurance companies, and 3 rating agencies. And linking them all together was the securitization food chain, a new system which connected trillions of dollars in mortgages and other loans with investors all over the world.
30 years ago, if you went to get a loan for a home, the person lending you the money expected you to pay him or her back. You got a loan from a lender who wanted you to pay him back. We've since developed securitization, whereby the people who make the loan are no longer at risk if there's a failure to repay.
In the old system, when a homeowner paid their mortgage every month, the money went to their local lender. And since mortgages took decades to repay, lenders were careful. In the new system, lenders sold the mortgages to investment banks. The investment banks combined thousands of mortgages and other loans, including car loans, student loans, and credit card debt, to create complex derivatives called collateralized debt obligations, or CDOs. The investment banks then sold the CDOs to investors. Now, when homeowners paid their mortgages, the money went to investors all over the world. The investment banks paid rating agencies to evaluate the CDOs, and many of them were given a AAA rating, which is the highest possible investment grade. This made CDOs popular with retirement funds, which could only purchase highly rated securities. This system was a ticking time bomb. Lenders didn't care anymore about whether a borrower could repay, so they started making riskier loans. The investment banks didn't care either. The more CDOs they sold, the higher their profits. And the rating agencies, which were paid by the investment banks, had no liability if their ratings of CDOs proved wrong.
You weren't going to be on the hook, and there weren't regulatory constraints. So it was a green light to just pump out more and more and more loans.
Between 2000 and 2003, the number of mortgage loans made each year nearly quadrupled.
Everybody in this securitization food chain from the very beginning until the end, they didn't care about the quality of the mortgage. They were caring about maximizing the volume and getting a fee out of it.
In the early 2000s, there was a huge increase in the riskiest loans, called subprime. But when thousands of subprime loans were combined to create CDOs, many of them